This is your Lead Left podcast for the week of June 19th. I'm Randy Schwimmer. Welcome back. A frequent question from investors and others is, when is a good time to invest in private credit? What they really mean is now a good time to invest in private credit? Readers of this column know one of our consistent themes is private credit is not a timing thing. On a panel at the Credit Flux U.S. Private Credit Conference last week, when we were asked that question, we said, you don't buy and sell car insurance every time you move your car in and out of your garage. The question on timing is by no means simplistic. We watched an interview recently in which the CEO of a global asset manager was asked whether he was still as focused on private credit as he had been several years ago. This particular firm also owns a significant direct lender. He dodged the question a bit, saying, I don't want to throw cold water on it, but the world is very excited about private credit, implying perhaps he wasn't. In a steady state, he said, you need both the public and private markets functioning. When pressed on private credit, he said, we're interested, but what's the opportunity set? The problem is the steady state doesn't exist. Banks have lost almost all their share of buyout financings to direct lenders with their fundamental inability to structure and hold leveraged loans when clearing prices are indeterminate. More generally, banks have not been the majority of primary loan investors in over 2 decades. It's unclear when or if they can recapture even the modest minority positions they held pre-COVID. In the meantime, private debt funds have been reaping the rewards of direct lenders' increased allocation in better priced, better structured assets. How about private equity sponsors being challenged to meet current fund return targets and raising new funds? How does it work when the cost of the capital stack is 10% or greater? The answer is, as has been the case for decades, you need to be nimble and resourceful with capital solutions. The best sponsors adapt. They add lower multiple acquisitions to platform companies. They get LPs to put in more equity co-investments. Mezzanine providers, and even higher capital cost strategy, are busy working with issuers to include cash pay to PIK toggles in their financings. But M&A is down this year. Doesn't that bode poorly for opportunities? Bankers are clear on this point. Dry powder for buyers and sellers is plentiful, just waiting for more clarity on rates and the economy. If you're on the sidelines, the second half will pass you by like a freight train. So what is the opportunity set in private credit? The CEO referred to non-sponsored and special situation strategies, but acknowledged neither have broad application today. The more specialized you get, the tougher to deliver attractive returns over long periods of time. When cycles change, rates, growth, inflation, so do the settings for those boutique opportunities. Reporting from the steady state offices of the Lead Left, this is Randy Schwimmer, wishing you and your families a safe and healthy week.